This is TreppWire Week in Review for the week ending April 12th, 2024. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Lonnie Hendry, Chief Product Officer, and Stephen Bushbaum, Research Director. This week, we got another reading on inflation with the release of the March CPI report. Ahead of the release, there was lots of what-if chatter about what might happen if inflation came in higher, lower, or even in line with expectations. So let's fast forward to our postmortem about what we learned from the report, given that we've had some rather drastic moves in equities and bonds on the heels of the release.
Well, let me start off with a bit of an unusual take on this. So, Lonnie, did you hear on Wednesday morning the thud right about 8:30 when the CPI was released?
Yeah, I think that was, I know you guys had an earthquake up there in the Northeast last week, but I think it was something similar. Yeah, a little more broadly felt.
It was. And my initial thought was, my gosh, what was that? Was it the earthquake? And no, that was the door slamming on rate cuts for May. And certainly some of us were wondering if that was the door slamming on June rate cuts as well. So let's talk about the move first. After the release of the CPI report on Wednesday, treasuries jumped up between the 2s, the 5s, the 10s, everything priced higher massively, and equities sold off. So that was the reaction function. So what happened with the CPI report that was so concerning and effectively just really crammed down the possibility of a rate cut? Because we've basically gone from 6 cuts to 3 cuts to higher for longer. And now the new narrative that came out, on Wednesday, I think, was when I started hearing more of this, was later and less. So we're going to cut rates later, and there's going to be fewer cuts, if any, in 2024. Well, the real concerning part for inflation hawks in this report is that inflation was very broad-based. It wasn't like we could pin it down to, say, something like shelter or auto insurance. There were a number of different subsectors that all showed a sticky rise. So we couldn't blame it on any one point. And this comes on the heels of 2 other warm or even hot inflation prints. So there's this real concern now about, I don't want to even say stagflation. It's basically just stubborn inflation. And that last mile that we knew was going to be very, very difficult now looks like, to some degree, it's just a question of when we should see the rest of this disinflationary trend, if you believe we're on that sustainable track. And that's really, I think, the biggest question right now in everybody's mind is, will we see a return of the disinflationary trend that we expect to see once, say, some of the shelter inflation measures burn off, once some of the very lumpy repricing moves in auto insurance roll off, or are we really starting to see some concerning price increases that are tied to labor market strength? Because I don't want to drone on this too much longer, kick it over to Lonnie here in a second, but we haven't seen really the wage increases, or I would say concerning inflationary strength in the labor market, that would make me think at this point that the disinflationary trend is completely stalled and we're about to see the Fed change their tone again and even put back on the table rate increases. But let's kick it over to Lonnie and see what he has to say.
Yeah, remember, Stephen, when this was just transitory? I mean, it wasn't that long ago that was the narrative, right? And like they've backtracked from that and said it was a mistake, but it's just really interesting to see how stubborn this inflation is being. And I think, to your point, maybe Powell didn't lie when he was leading up to rate cuts in December. What he didn't tell everyone is he was just cutting the probability of rate cuts. Like, we've gone from 6, to your point, to 3 to now 2. Who knows if there's going to be any rate cuts in 2024? I mean, I would take this last reading and say I'd probably be pretty bearish that there's any rate cuts in 24 unless there's some political motivation behind them. Like, the data is the data. You look at car insurance inflation, 22.2%, transportation, car repair inflation, like all these things are like near or above double digits. The insurance stuff that you talked about with cars, I mean, I just quoted my insurance this last week on my vehicle is 45% increase. Homeowners insurance, significant increase, and for less coverage, deductibles are going up. So instead of like 1% wind and hail damage in Texas, it's now a 2% deductible, and they won't write a policy with less than that. So it's real time, and you could argue that the reported CPI is too low compared to like what our paychecks, grocery bills, gasoline cost, all those things actually indicate true inflation to be. there's a negative buzz this week. I like your analogy of the door slamming because I think that's really what's happened, and you look at the labor market and it's interesting there. It's still hot. And so I don't see a bunch of relief. I don't see something that's going to, kick off this need for rate cuts. And even for the CRE and CMBS market, if you're wondering, like, what does this mean for us? If they make 2 rate cuts in 24, I mean, like, does that even move the needle? I don't think it does anything. Like, it's maybe some psychological benefit, but 25 or 50 basis points in rate reduction does not move too many deals across the finish line that are hinging on a 25 or 50 basis point reduction. And I think when there was talk of 6 or 7 or 8 rate cuts or whatever the high watermark was at the beginning of the year, people were kind of backing into the math that could really move the needle. 25 or 50 basis points is a rounding error given where we're at today.
So what I really wonder about, since we are an interest sensitive asset class, is given that we've repriced higher by 30, 40 basis points on the treasury curve over the last, call it 6 weeks to 8 weeks here, is will we see deal flow and CMBS issuance dial back at least slightly? And my gut feeling is yes, because usually when you get this much volatility, I love the line, well, if you can't price the underlying risk-free asset, how can you price the risky asset? Maybe we've gotten over some of that headache, and it won't drop as much as it did in the back half of last year, but I suspect we have to see a decline given how strong issuance was in the first quarter.
Yeah, I would take maybe a little contrarian approach to that and say, with each month that passes and there's no rate cut, I think it may actually build some resilience into the market where people say the higher for longer is true. The hope's not a strategy. And at some point, sellers capitulate to like what the market really is. I mean, I think that's the part that just hasn't happened yet, where had a lot of extensions and modifications. We've talked about them at length here on the podcast. At some point, that's not going to continue to happen if rates stay where they are and assets that are obsolete continue to remain non-viable in the market. And I think you're going to start seeing some basis reset. I mean, we're going to talk about it today with the large office tower in St. Louis that transacted. I mean, there's a lot of those types of buildings sitting out there. So I agree in the sense that like this net negative news probably pulls back, but at the same time, we've been saying for a very long time the uncertainty that's been surrounding the market has really led to the pullback. If people become more and more certain that this is the market, I think the market by definition adjusts to the current factors that are at play.
Yeah, absolutely. Because we have seen, I mean, to your point, an inoculation effect of higher rates and basically coming to terms with that. And that's why we've seen the 5-year deal gain so much traction, is at least that gives you a less costly off ramp if rates do decline. Like, as you said, hope's not a strategy, but if it does hit, then at least you're getting a lower defeasance cost or being able to refinance at that 5-year maturity rather than having, say, another 4 or 5-year defeasance period that you're having to pay for on a 10-year loan.
Yeah, the 5-year is been a really good saving grace for the market, and I think it's a great hedge. I mean, you can get in with a rate you don't love today, but you can kind of lock it in. And if the Fed, as we mentioned, let's just say for them to get measurable traction on rates to where it materially impacts the market in a positive way, is going to require 4 or 5, 6, 25 basis point cuts. And if it takes 2 a year, you're not going to be, like you're saying, not that far out from being in an open period or having the ability to pay a smaller defeasance. So I'm still optimistic that maybe 24 is kind of a reset year. We've started off the year really strong on the CMBS private label side. Maybe we continue that trajectory. People just kind of settle in. Obviously, we all would like to see inflation come down, but at the end of the day, I would rather see the Fed kind of hold firm and us not have some run up after the fact and kind of get us to where they need to be before they start cutting rates just to cut rates.
Yeah, the last thing the Fed wants to have happen is to end up in a 1970s, 1980s Fed conundrum where inflation gets embedded. So I'll be curious to see, depending on what we get, because we still have 2 more CPI releases plus PCE ahead of the June Fed meeting. So we'll just have to wait and see. I would call out one other report we got this week. The PPI inflation report, producer prices increased 0.2% for the month, less than the 0.3 that was the consensus estimate. So, that was just the slightest bit of hope for those wanting to see a June rate cut come through, even if it's only 25 basis points and we don't get another until maybe September, even December. That PPI report did keep some of the rate cut hope alive. And just to throw out one specific data point, because I love to quote this one, the CME FedWatch tool to quantify the moves that we've seen in the repricing. So if I look at the June Fed meeting rate cut expectations, 1 week ago, there was a futures implied probability of a 34% chance the Fed would hold rates their June meeting. So that was 34% 1 week ago for a Fed hold in June. That probability of a hold spiked to almost 84% yesterday. So on Wednesday, after the release of the report, that got dialed back slightly today after the PPI, and has come down to about 77.4%. So you could argue this is probably a de minimis move. If we calculate the standard deviation, right, and put this within a confidence interval, you'd say, yeah, I mean, it's kind of a negligible move, but that's why I said there's the slightest bit of hope lingering on by a fingernail for that June rate cut. But I'm with you, Lonnie. I just don't see the supporting data points. The Fed keeps saying they're data dependent, and the data has not broken the way that it would need to for a rate cut.
So something else that happened this week, we saw Blackstone make a $10 billion purchase for multifamily, and they went on the real estate offensive, as the headline said. We wrote about this in our rundown newsletter, and we might have caused a little bit of a stir up on Twitter when we reported the cap rate, but we have the real news now, and we wanted to break down some of that story today.
Yes, and apologies to any of our rundown readers who did some head scratching, and I also want to say thank you for reaching out. It was not our intention to mislead anybody about what the cap rate was or the implied cap rate was in this purchase. So let me start off by saying the Blackstone deal was, in my opinion, some really, really good news to see, given the size of this transaction and some of the stress that we've seen in the multifamily sector that, you might have thought could have caused some bid-ask spread discrepancy on a deal of this size. So specifically, if we did see as concerning of cracks as we've talked about for certain markets, not that we've painted those concerning, but we've just highlighted some supply pressures and occupancy pressures. So if those truly were a problem, I don't feel like we would have seen this deal get done. And Lonnie, feel free to chime in and disagree. But to me, like, that was the high level takeaway is, this is a great sign of strength and conviction for a sector that's had some cracks bubble up, on the fringes.
Maybe I take a slightly more negative appeal, which is funny because for those of you that work with me, I'm pretty optimistic and upbeat all the time. But sometimes on the pod, I have to be like the sober, somber voice of reason here. Does Blackstone have enough dry powder to move the market themselves? And what I mean by that is, like, we've seen the narratives, right? We've seen them on CNBC, we've seen them on Bloomberg, we've seen them talking about now's the time to get back in. The market has shifted. We're going to be active. We're going to be moving, making deals, whatever. Okay, they got capital to place. We get it. And like, you come out of the box with the $10 billion investment, that kind of shifts sentiment. I mean, like, to me, like, it almost is like they almost, and I'm not suggesting that they do or that it's a negative thing in any way, but like, they can almost shift sentiment, like if they make an investment like this, it kind of bolsters, to your point, like the perception of that asset class changes with this one transaction at some level. Maybe it's not critical mass. Maybe it's not enough to move the needle. And I'm giving a little bit of hyperbole here, but it does feel like when Blackstone or when we see BlackRock or we see some of these other folks come out and affirm that they're going to be taking action, and then you see something like this happen, there has to be trickle-down effects to the market that otherwise wouldn't have organically taken place, in my opinion.
Yeah, I'm glad you point that out because I should be a little bit more clear. The positive sign, or at least the positive takeaway for me on this deal, was that if we did have some signs of stress or uncertainty about future rent growth and occupancy and the supply pressures, is I would have expected this deal to break down at some level. And maybe that's what's already happened. I'm not familiar with the full backstory and how long this deal took and any of the repricings that happened. But for me, I'm just going to take it as simple as I can, that the fact that it did get done tells me that disagreement did not cause a breakdown in pricing and execution. But exactly to your point, Lonnie, is Blackstone's scale, scope, everybody looks at them, listens to what their narrative is to take some cues. And they are absolutely, in some cases, it feels like a self-fulfilling prophecy. Very curious to see what kind of momentum shift or change in narrative we might see on the heels of this deal. So let's unpack a little bit more about the details in this transaction. So Blackstone agreed to pay roughly $9.4 billion for AIR that has 75 apartment properties with just over 26,000 units in a number of major markets. So Blackstone is paying $39.12 a share in cash for each of the company's nearly 155 million common shares and assuming $3.4 billion of debt as part of this deal. Now, if we look at AIR's portfolio performance last year, they enjoyed a 9.3% increase in NOI that brought them to $691.71 million. And that includes NOI from both real estate and other operations. So let me be clear about that NOI number that I just threw out. That was the number we had used to calculate the 7.36% capitalization rate that, as Haley said, caused some stir on Twitter, because that included the non-AIR share of NOI for properties. So after you back that out, it drops the NOI, obviously, as it should, and brings the implied capitalization rate for that transaction down to roughly 5.9. And some of the posts we read said it's somewhere in the ballpark of 5.7 to 5.9% cap rate. So, that's a pretty dramatic repricing of apartment properties when, we were coming from, we roll back the clock 3 years ago or 4 years ago. Some stuff was trading at a 3 handle, right, Lonnie?
Look, at face value, 5 is a pretty significant number relative to where we were. At the same time, though, you're not doing this transaction like without the scale. Like there's no way they could execute on each of these individually and try to come up with some sort of a package that even comes close to this. So I think it just is another example of Blackstone's ability to execute on these large portfolio deals at a number that they're comfortable with, that makes sense for them, given their cost of capital, given their position in the market, that maybe doesn't make sense outside of that. And I think that's the challenge. Like, just like we had the snafu on the cap rate, and we could have a whole episode on just the different approaches to cap rates and what they mean to everyone, because everyone has a slightly different interpretation of cap rates. But like looking at Blackstone as some proxy for market from a cap rate perspective is a challenge, just because they're at a scale that just not many others are in the marketplace, and they have business motivations at this portfolio level that other people just, it wouldn't make sense for. So they have a track record of doing this. We saw, I think they had the American Campus Community stuff last year. They've had a bunch of other deals over the last several years. Like, I would view this as if Blackstone's moving forward, we're going to see a lot of other people being a little more aggressive in the multi-space, because even at this point, if you look at the 5, whatever cap rate that they bought this on, they're probably in a negative leverage position if they have to refi those properties right now, given the current rate environment. So, and we don't have visibility, obviously, into what the financing situation is on those individual deals. I'm sure they'll pick the winners and leverage them up and kind of go through the process. But I'm not betting against Blackstone, especially not when it's this type of a transaction. I can promise you this deal will work out favorably for them.
And keeping on the topic of multifamily, we saw some loans move to special servicing this week.
First up, we have the $25.8 million Oak Park Village Apartments loan that was transferred to the special servicer due to payment default. The loan is currently 60 days delinquent and is scheduled to mature in June 2024. The collateral is a 618-unit multifamily garden-style apartment and townhome complex in Lansing, Michigan. It's a 1977 vintage property that was renovated in 2009. And the loan is in a 2014 CMBS deal that is part of CMBX 8. The debt service coverage ratio on a net cash flow basis for this loan through the first 9 months of 2023 was 1.31 times when the occupancy was 72%. Now that is up slightly from the 2022 financials that had a debt service coverage ratio of 1.19 with occupancy of 70%. So a marginal increase here, but this is still down from what we saw in 2020 and 2021, and certainly from years back when coverage was 1.5x or even as high as 2x in the pre-COVID era. So another case of cash flow has just been ground down, and it's finally reached the breaking point for this loan. The borrowers clearly had no other choice than to bring it into delinquency.
Yeah, there's another property here, Stephen, in Detroit. Different location, same story though, effectively. You have senior housing property that's taken to special servicing. This is the property Walton Wood at Lakeside, $17.4 million loan on that property has been transferred to special servicing. This is due to balloon payment at maturity default. Loan has struggled for the last several years with delinquency, has remained current over the past 12 months. So there was maybe some hope of it paying off. It didn't. Original balance on the loan was 21 million. It was scheduled to mature in March of 2024. Back in February, we commented that the borrower had not requested a payoff quote, been on the watch list due to the upcoming maturity date. So this property, 122 unit, about 143,000 square foot senior living complex built in 07. It's in the suburb of Sterling Heights, Michigan. And this is one where, like you just mentioned, DSCR at origination was 1.38x. At the year end 23, it was at 0.67x. And what's interesting is occupancy was actually higher in that 2023 year end number than it was at origination. It was 91% in end of 23 as compared to 89% at origination. So significant deterioration in both revenue and increase in expense that really negatively impacted this property.
Up next, we have some Chicago apartments selling. David Gassman has sold a portfolio of 17 properties with 300 units in Chicago for $72.4 million, or just over $241,000 per unit. This comes to us from Crane Chicago Business. The local investor sold the properties to 8 different buyers in deals brokered by Essex Realty Group. Slater Realty and Investments purchased the largest chunk of the portfolio, totaling 125 units. Other buyers include Casey Capital, Highland Real Estate Partners, Aljack Investments, and Fairmont Property Management. Individual properties were sold for $1.4 million to $23.5 million.
No, that's getting me excited for summertime shy. I don't know if you guys have been to Chicago in the summertime, but it's pretty tough to beat. My brother lives outside the city there, and about 9 months out of the year, not my thing, but that summertime Chicago atmosphere is pretty tough to beat. So maybe I'll get to go visit some of these stories that we've read about or whatever in Chicago. We have some dedicated listeners that come to us from Chicago that own some apartments. So maybe we can get some boots on the ground tour from what's happening in that Chicago marketplace this summer.
Calling all investors and real estate enthusiasts. Ready to unlock prime commercial properties without the fuss? Look no further than RI Marketplace. Their impressive stats speak for themselves. Over $4.5 billion transacted since 2017, and over 100,000 investors finding deals that were once out of reach. And here's the clincher. Their exclusive hotel auction on May 8th is your ticket to success. Visit rimarketplace.com to join the auction. Imagine a marketplace where over $4.5 billion in commercial properties have found new owners, and more than 100,000 investors are finding opportunities that were once out of reach. Welcome to RI Marketplace, the leading commercial real estate auction platform. Join today to access our Extended Stay America Hotel auction on May 8th. 12 hotels with endless possibilities are up for grabs. Join the auction today at rimarketplace.com. And another headline that we saw this week, so we'll shift gears to the office market, was a story in the Wall Street Journal about the state of downtown St. Louis, stating that the office district is empty with boarded up towers, copper thieves, and failing retail. What are we seeing here, and is it truly the doom loop that has been in the headlines?
Certainly from the way the story reads, they definitely painted it like a classic urban doom loop type story, with the city officials being very concerned about how they could try and revive the urban center, given the drastic emptying we've seen of some of these office towers. So the AT&T office tower that sold in St. Louis sold for a really astonishingly low price. It sold for $3.55 million, which works out to around $2 per square foot, when this asset was sold for over $205 million in 2006. So certainly when you see an asset that large sold for that low of a price, and then it's a great Wall Street Journal article. So for any of you that are interested in the story but didn't catch it from the Wall Street Journal, I highly encourage you to take a look, because St. Louis is a very interesting city, very old, lots of manufacturing background. And so anyway, without getting into too much of that backstory here, yeah, it was pretty rough to see what I always loved as a kid, seeing, urban St. Louis with boarded up windows and graffiti, and seeing things about kids with GoPro cameras strapped to their heads just sauntering into an empty office building to pull some shenanigans, harmless or otherwise. At $2 a square foot, Lonnie, help me out. What does it take to get crammed down to that sort of a sales price? Because usually when I see that, I'm like, okay, what's the environmental problem or what's the encumbrance that I'm missing?
Yeah, so I just want to highlight that Stephen just used shenanigans in a CRE story discussion, which is kind of funny. Look, this property's been on the radar for a very long time. It went on the market, it sold for 200 plus million, had some tenants, like just didn't work out. The asset now sold for $2 a square foot. I mean, like what that tells you is that it sold for land value less demolition cost. And in this case, demolition cost is probably going to be pretty high because I believe there's asbestos in the building and that's going to complicate things. And so I don't think even at this basis, I would be really surprised to see an owner come in and try to revamp this building into something better. I think you're going to see it come down and they're going to build something new there. It's a really tough pill to swallow. I mean, huge write down on this deal. And I don't think it's necessarily indicative of the broader St. Louis market. I mean, there's a lot of negative headlines around St. Louis and the office space in particular. But there are some buildings not that far away from here that are in that 70-80% occupancy range and, struggling to get by, but still getting by. This is one, though, that just jumps off the page. I mean, for everyone that wants to talk about urban doom loop, this becomes the poster child for that discussion going forward at this point. This isn't like even San Francisco where we saw properties trade at, $750 a foot, go to $250 a foot or whatever. This is $2 a square foot. I mean, it's just a pretty tough pill to swallow.
It is, but one of the bright spots in this article talked about the reinvention of downtown West that's full of beautiful old buildings where the Taylor family, the owners of Enterprise Rent-A-Car, spent really big to try and revitalize the downtown West. And they spent big to build a soccer stadium and bring the MLS team to the area. So, while the office pocket of that downtown area is absolutely decimated from the pictures they show, from the data points we see, outside of that, there are some bright spots. So to me, this is, okay, yeah, the urban doom loop is absolutely concerning, but people still live in these areas and want to see something done. As a culture, we don't like seeing space go to waste. We try and come up with creative ways to repurpose it. And usually the hurdle is the price point. So, this speaks to, okay, once the basis reset is low enough, and assuming the demographics and the want is there, the demand side is there from consumers, there is a path forward. And the downtown West area certainly has some good things going for it, based on what I'm reading here.
Yeah, I don't think this is a signal for offices broadly. I don't think we're going to see a run on office where people start selling offices for $2 a square foot. But this just does reinforce that it's not all, hype and clickbait and whatever. There are some properties that are going to trade at something close to this. And it's happened. I think that we had a story in Minneapolis a few months ago, large corporate campus. It was something like $7 or $11 a square foot. The number, I don't remember exactly, but it was another one of those where your eyes jump out. You're like, wow, that's crazy. So there's going to be a few more of these, until things get better. But, hopefully someone the person that acquired this has a vision for what this property is going to be. And to your point, Stephen, with this type of purchase price, it creates opportunity for revitalization in that market. And unfortunately, somebody has to lose out, but hopefully, they turn this into something that's more vibrant and it actually becomes a net positive for that local marketplace. So be one we keep our eye on for obvious reasons.
And just to put this distressed sale price in a little bit of historical perspective, any of you that are familiar with Texas and specifically the Houston market, the Woodlands submarket back in the 80s didn't exist. But, when banks were liquidating any of the loans and investors were liquidating assets during that period, that's basically how the Woodlands got started. Was if you're flush with cash and you see opportunity, I don't know exactly what the price per acre was on the Woodlands asset purchase because it was done through a sequence of sales. But it was, from what I understand, just pennies on the dollar for what that land had traded at, anywhere from a couple of years to maybe up to a decade before that. And so, yeah, crisis breeds opportunity, and those that have creativity and capital are well positioned to execute.
So let's talk about a few other office stories that caught our eye this week.
I'll jump in here, Stephen. We have City refinancing the Flatiron offices and retail loan, $155 million takeout. So City Real Estate Funding refinanced the 140 million, 2840 West 23rd Street. It provided nearly a decade ago with 155 million in new financing. So this is the 578,000 square foot mixed use building located in West 23rd Street in the Flatiron District. We're not exactly sure of full terms of the loan, although we do expect it to go under securitization. So we'll have that data, forthcoming. But at this point, it's a good story. The property is a mix, 450,000 square foot of office space and 120,000 or so square foot of retail, which is fully leased to Home Depot until January of 2036. And this is according to CRE Direct, our sister company. That Home Depot's lease was renewed in 2020 and likely entails increased rental payments from its previous annual rate, which was a pretty staggering $52.93 a square foot. So this is a good story for a mixed use office and retail building there in New York.
Up next, we have the firm that just keeps on giving. WeWork plans to reject 4 additional leases in DFW next month, absent a renegotiation. So WeWork has filed to restructure the lease terms at Williams Square in Irving, Victory Park in Dallas, Legacy Town Center in Plano, and Legacy West in Plano, according to a filing this past Sunday with the U.S. Bankruptcy Court for the District of New Jersey. A 5th common desk location is under management review and slated for rejection. So in the absence of any new arrangements with landlords, the firm will reject those leases on May 20th, according to a WeWork spokesperson, as told through BizNow.
Yeah, so these stories are going to keep trickling in. We covered a couple, I think about 3 weeks ago on the pod, and I think we'll see these just kind of trickle down. It's interesting. They'll probably go geography by geography is what it looks like. And these are in pretty good locations. So in the Dallas metro market. So it'll be interesting to see how quickly these spaces get backfilled, because I do think there's going to be some demand for those spaces given the locations.
And the last story we'll have to wrap up the office segment is a sale agreement was approved by the court for a suburban Chicago office center that's in receivership. According to March remittance data, the property backing the $18.8 million Oak Brook Office Center loan saw a drop in its appraised value to $13 million. At securitization in 2013, the property was valued at $33 million, but its value was cut well below the loan balance, and an appraisal is dated in December 2022 following its transfer special servicing in April 2022 due to payment default. The collateral is a 4-building, 312,000 square foot suburban office complex built in 1977 and renovated in 2001, located in Oak Brook, Illinois, a suburb of Chicago. Sanford, which had been occupying the entirety of one of the 4 buildings at the office complex, and they accounted for just over 39% of all square footage at the complex. Sanford vacated at year-end 2021. That caused occupancy to dip to 32% in 2022 from 75% in 2021, and debt service coverage has been negative since that move out. A receiver was appointed in August 2022, and a PSA was executed earlier this year. Comments indicate that a buyer has been located and that a closing for this transaction is expected in the fourth quarter of 2024.
So, Stephen, we covered some office stories today, and we covered the urban doom loop pretty much in detail, given the Wall Street Journal story. Where we sit today, we're recording this on Thursday, April 11th. What's your take on Chicago, San Francisco, LA, New York, and the office markets? We've talked the last couple of weeks about this push-pull narrative between complete distress and the tides turn and things are going better. It seems like every week we're seeing a mix of both. I kind of just can on the fence that for every good story, there's a bad story. For every bad story, there's a good story. What are your thoughts around that across the 5 gateway cities?
So I think one common thread that personally I've tried to pin down, and looking at performance and trying to explain away, what the differences are in the positive and negative headlines across cities. Ultimately, it comes down to how healthy is the corporate environment in each of those areas. What kind of migration have we seen? What are the crime trends? What's the amenity sets? And trying to piece all of this together. And for me, New York City has the amenities. It saw a return, albeit, we might still be down from 2019 population levels, but we have seen a backfilling of renter demand as employers have called people back to the offices. Right? And you have the amenity set. You have the street level retail that wasn't completely decimated in areas like it was, say, in Portland or Washington, D.C. And crime has certainly been a factor in those areas. So to me, I look at this and I think, gosh, there's like a really long road ahead for some of these metros to claw back to seeing more positive stories. And the areas where we are seeing those positive stories generally have the fundamentals in place to make things work. So the one bright spot in St. Louis, for example, the MLS Stadium was a key component of that downtown west revitalization plan, where you have the absence of those amenities and some of the other structural problems. It's going to be where you're going to continue to see the particularly negative headlines, the distressed sales, and the challenges ahead that, gosh, we still have easily 3 years to work through some of these issues.
Yeah, that's the part. We're still super early in the cycle. We got to coin the next phrase though, like urban doom loop is taken on the negative. What's the positive tagline going to be?
Ooh, that's a good challenge. Maybe should we open it up to our listeners?
I think we should. If you have like an idea for what the next boom in the office sector is going to be, send us an email at podcast@trepp.com, and maybe we'll read the best ones on next week's episode.
All right, so let's focus on retail. You guys have a lot of names for different retail periods, right? Retail Renaissance, retail apocalypse. So we already have those names.
We've got Haley all tongue-tied here with our creative naming conventions of the different asset classes. But as she mentioned, retail, we've gone from the retail apocalypse to the retail renaissance. And it's more good news for some retailers and bad news for others this week. So out in Scottsdale, an affiliate of Ziff Real Estate Partners paid $26.5 million, $223 a square foot for Mercado at Scottsdale Ranch, 118,000 square foot shopping center in Scottsdale. Sales price was first reported by AZ Big Media. The Mount Pleasant, South Carolina company purchased the property from Whitestone REIT, which had acquired it in 2013 for $21.3 million. Newmark represented the seller, Whitestone, in this latest deal, and Protective Life Insurance Company provided $15.7 million worth of financing to facilitate this most recent purchase. So that was a good headline story, Stephen. I'm going to read one more here on the downside, and I'll let you comment on this one. According to March remittance data, property backing $101 million shops at Buckland Hills saw a drop in its appraised value to $59.4 million and is approaching half of the loan balance. The appraisal date is from November of 2023, and the collateral consists of 535,000 square foot of mall space in Manchester, Connecticut. We didn't say that wrong, not 50% loan to value. The value is now 50% of the loan, right? So it's like an opposite day. At securitization in 2012, the property was valued at $189 million, so significant write down. In 2020, was valued at $189 million. So this most recent appraisal was a significant write down, but it's had several write downs. In 21, the value was slashed to $59.95 million. In 22, there was a little bit of a recovery where the value rose to $72.2 million. And then, as we mentioned just a moment ago, $59.4 million on the recent appraisal. So obviously this property is delinquent and is set at loan is non-performing maturity balloon. If you're a TreppWire reader, this is not surprising for you. In 2020, we covered the fact that they submitted a hardship letter indicating the debt service and operating shortfalls would not be funded, and that the release of cash management funds for critical past due property expenses would be necessary to maintain operations. And this was later moved to receivership in July of 22. So we've gone through, and I could go through a bunch of different bullets. We reported Dick's Sporting Goods was going to be moving to a new location a mile away. They were the largest collateral tenant with 80,000 square feet. So it's just like, bad news got worse. And then obviously with the announcement of Macy's, this became another potential negative downturn for this mall. So more to come on this. Not great news for this Manchester, Connecticut, shopping mall.
See, Eleni, this one's interesting with Dick's Sporting Goods moving a mile away, which is really can be like one of those death blows. I feel like ultimately when you have what typically is a retailer with a very strong amount of foot traffic, shouldn't say a death blow, but it's a very negative sign. So I'll be interested to see what kind of repositioning or backfilling can get done for that Dick's Sporting Good location. Additionally, with the Macy's exposure here that we put out for the loans in the spotlight back in February, if that ends up being on the chopping block. If we recall, Macy's did not put out a hard and fast list of closures. And so once we start seeing which of the Macy's locations will we put on the chopping block, that'll give us a very clear signal on foot traffic performance at some of these malls. So that's a data point I'm certainly eagerly awaiting to get here from Macy's.
Yeah, you also know too on some of these, Stephen, when they go into receivership, that's when a real execution plan and kind of repositioning can take place. And so I wouldn't write these malls off. I mean, we've seen a lot of these kind of go through this process and then emerge stronger where they subdivide some of that big block space and they reimagine what the mall is supposed to be, given today's consumer demands. And so this is one, as we mentioned, we've talked about for several years, and it's one that we'll probably continue to talk about as it, goes through whatever transition is next for it.
And as a quick pop culture plug, did you know that this mall was the location for a music video, Miracles Happen When You Believe, that was in The Princess Diaries in 2001?
All right, Stephen. All right.
Sorry, that was all Wikipedia.
I think we have one industrial story today, so let's pivot to that sector.
Sure. So the one industrial story we have is Ares has paid $65 million for a California industrial property, or roughly $248 per square foot for the 258,000 square foot industrial property at 7400 West Hazard Avenue in Westminster, California. And this comes to us from Commercial Property Executive. The Los Angeles investor purchased the property from Clarion Partners, which had acquired it in 2013 for $26.7 million. Cushman & Wakefield brokered the deal and arranged financing to facilitate the purchase. The property was built in 1969 on a 12-acre site that's 34 miles south of Los Angeles. It is 72.6% leased and has 22 to 24-foot clear heights, 28 dock positions, 5 drive-in doors, and 140 parking spaces.
I love getting some industrial stories in before we wrap up the podcast. Like we usually have industrial as a very last topic. And I think today we're going to close out with some lodging stories. So industrial is moving up the ladder. In fact, given this is Masters Week, it's moving up the leaderboard.
Ooh, nice.
So as I segue into lodging, Trumbull Marriott receives further appraisal reduction. So this has been the day of appraisal reductions. This $19.5 million Trumbull Marriott loan has seen the value of the collateral cut again. The value was lowered in 2017. The property was valued at $35.1 million. The value was lowered to $14.5 million in 2020, obviously due to COVID. Bumped back up to $21 million in 2021 post-COVID, and unfortunately again lowered to $11.5 million in January of 23, which we thought would be the low water mark. And more recently was just lowered to $7.3 million. This is according to the March data. This property's occupancy stood at 52% in 2022, and most recent servicer data shows positive NOI for the 12-month period between July 22 and 23. But unfortunately, the property is just not performing. And so in this case, the borrowers indicated they're going to be cooperating and do a friendly transfer title to the lender. This is tied to a 2017 deal. After much debate on the podcast team in our pre-podcast discussions, Citaris, or otherwise pronounced Citares, we're going with Citaris though officially. Citaris Management LLC has teamed with Belcore Capital Partners to buy the 390-room Hilton Boston Back Bay Hotel at 40 Dalton Street in Boston for $171 million or $439,000 per room. The venture bought the property from Ashford Hospitality Trust, which has been selling properties and raising capital in order to address a lot of upcoming mortgage maturity. So we've seen a lot of Ashford activity over the last couple of months. This hotel in particular includes a 209-space parking garage, operated really strong last year, 90.9% occupancy level, and generated a $291 average daily rate and $265 RevPAR for this property. Ashford says the sales price resulted in a 7.3% cap rate after taking into account projected capital expenditures. Without the CapEx calculated in, the cap rate's at 8.7%. The sale allowed Ashford to retire a $98 million loan against the property that was provided in 2021. The loan coupon pegged to LIBOR plus 380 basis points. So the venture that bought this plans to invest additional capital into the property, which is near a number of Boston's biggest tourist attractions, including Fenway Park and Symphony Hall. So great purchase for the folks at Certeris, and good news for Ashford given their upcoming maturity walls that they're facing, being able to get this loan retired as well.
And to wrap up our lodging sector, finally, we have an Arizona hotel selling for $124.3 million and getting financed through a $75.4 million loan. So Trinity Investments has paid just over $307,000 per room for the 404-room Scottsdale Plaza Resorts and Villas in Paradise Valley, Arizona. And it funded its purchase with a $75.4 million loan provided by Acor Capital. Trinity purchased the property from a venture of Rockpoint Group and Highgate Holdings. The price paid was first reported by Arizona Big Media. Rockpoint and Highgate, which were represented by Newmark in the latest deal, had acquired the property in 2021 for $90.75 million. To facilitate that purchase, Wells Fargo Bank had provided $67 million of financing. The property at 7200 North Scottsdale Road was built in 1976 and is about 15 miles northeast of Phoenix.
All right, so a programming note before we close. We've been talking about this for a few weeks, but we still have some spots available for our New York City CRE event that we're hosting May 9th and 10th. We have some new speakers announced. So last you heard, we had Victor Kalanog of Manulife presenting an economic update. We also have Greg Corbin, president and founder of Northgate Real Estate Group, Ruth Culp-Haber, who we gave a shout out to last week as the queen of the sublease. She's the founder of Wharton Property Advisors, and John D. Busey, president at Newmark, and Doug Larson, executive vice president at Newmark, who will be giving us a property types perspectives panel diving into what they're seeing from their different roles across the industry. So a lot of great speakers so far and more to come. If you're interested in registering for that event, send us an email to podcast@trepp.com and we'll get you a special discount code for being a listener. And turning to shout outs, a lot of people were interested in our bank CRE loan data. So Lizzie C reached out for our taller report. Andrew L was interested in our Trepp Future Leaders program. So we're still accepting applications if you're a young professional or a student in the commercial real estate industry graduating in May 2024. Jennifer Y is a dedicated listener of TreppWire and said she has been a Trepp career user since 2000. She thinks, but her memory is fuzzy that far back. So thank you for being someone so loyal and involved with the Trepp name for so many years. She congratulated us on our 250th episode and was interested in our event in May. So we hope you could make it there, Jennifer. We'd love to meet you. Tom C reached out to us off the recommendation from one of his professors at Harvard. So it's great to hear that the School of Harvard is listening to the TreppWire podcast. He's thanked us and said to keep it going, so we will. Tracy was very interested in our event, so we hope you can make it from Canada. And he was also interested in our bank CRE loan data. Anna S was interested in our Future Leader program. And Avi S was interested in attending our event in May, so we'll see you there. Aaron F just recently started listening to the podcast and finds it very informative and is hoping to meet us in New York City. So we hope to see you there as well. We had a great episode last week that we released with Oscar Parra, CFO of Pacific Retail Capital Partners. So thank you, Oscar, for sharing your insights on the enclosed mall space. And we just want to thank the team behind Oscar's podcast for working with us, Matthew C., Najla, and Kerry.
Yeah.
And we saw that our friend Ken A's CREI LinkedIn list came out this week. So if you don't know what that is, that shares all of the influencers in the commercial real estate space that are big and powerful on LinkedIn. So we had a lot of our friends and loyal listeners who were named to that list. But Robert P., our friend that we met in Detroit, we gave him a congrats and he said he enjoys our podcast with Lonnie and Steven every week and is listening for his shout out. So here it is, Robert. And then we had a few more inbounds from Alexander G, Manoj R, and JS.
Yeah, and Haley, I had a couple I'm going to toss in there today. And Robert P., as Haley mentioned, congrats on the recognition on the CREI list. Robert's a really great guy and always interacts with us on the different social channels. Courtney S., I met her at a happy hour yesterday for CCIM North Texas chapter. Courtney S. is the chapter president for this group, and it was a really great event. I also got to meet Ross M., Cameron M., and Andrew B. So really great to just get to shake hands and meet people, listen to the podcast week to week, and just make some broader connections in the CRE landscape. I know it's a pretty big marketplace out there, but it's pretty small on the people side of the business, and it's always great for us to get to hang out with some folks in the business.
And to that point, Lonnie, many of you may know, but we are recording live at the Real Estate X Gala, which is hosted by Strip Mall Guy, aka Don Tepman, and Bob Knackle. So we're really looking forward to that event. It's coming up very quickly. But this week we had the pleasure of chatting with a bunch of the experts in the industry to get some preliminary sound bites and clips for the podcast. So we wanted to give a shout out to Antonia B., Nick H., Sean S., and Kyle M.
For those intro podcast recordings, Haley, pretty much fire. It was really great to hear from these folks, and it's amazing to see and very quick and easy for us to pick up on why they're such big influencers in our space. I mean, these folks are cream of the crop when it comes to their respective fields, and I think our listeners are really going to enjoy us getting to do a little bit of a quick hit before the gala and then a deep dive, during and post. It's really great to make these connections and hear from them firsthand, not just through their Twitter handle or their online persona. It's pretty amazing what these people are building in real time.
So a lot more to come from the TreppWire podcast crew. So we're still going. We have a lot more exciting things coming out, and we thank you all for listening. And with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire podcast with your favorite provider. Thank you for listening, and stay well.
All right.